time for almost 20 minutes worth of questions, because we tend to finish right at 6.
I'm curious about the
John, wait,
proliferation.
hold on.
I'm curious about the proliferation of the funds over the last, whatever it is, 40 years, 1970, 2011, and what impact you think that that's had on the stock market.
In a way, this is part of financial intermediation that is a good thing. I think the mutual fund is a way, a very low-cost way of giving people diversification. Having said that, the best part of that, in my view, has been the index fund, and there are a lot of index funds, because that gives an individual the chance to get that diversification at the very lowest cost. So it's like everything else, the growth of an industry. There's a part of the growth that I'm not sure is the best thing for individuals, but look, this is a very profitable business. There may be mutual fund managers in the audience. I mean, they'll tell you it's a damn good business. So that's the way capitalism works.
There's no doubt about it, by the way.
Fortunately, index funds are growing. They're not growing as much as I would like to see. Some people say to me, Bert, aren't you disappointed? You've been telling people to buy index funds now for almost 40 years. And maybe 25% of individual investors have index funds. Aren't you disappointed? And I'm not disappointed at all. If there's an idea that comes out of the academy, you know, ideas championed by people like Bill Sharp, and you have an idea coming out of the academy and it's got that much traction, that's a very good thing. So I don't feel disappointed at all, because the index funds and the broad-based ETFs are growing, and I think they're going to continue to grow.
Yes, right here.
So sort of on the opposite side of index funds is this whole world of hedge funds. I'd love to hear your thoughts on hedge funds, and specifically, you had made the case that for the long-only funds, it's a zero-sum game. But for hedge funds, where you can also short and have specific, deep knowledge in certain areas, managers might be able to outperform. But I'd love to hear your general thoughts on the general hedge fund industry.
Yeah, I've done a fair amount of work on hedge funds. The data are very hard to analyze, because there's not only enormous survivorship bias, because there are some years when 20% of the hedge funds go out of business, but there's also, unlike mutual funds where they all have to report, you report your returns as a hedge fund if you want to. So there's that kind of inclusion bias. Having corrected for those, I do not find that hedge funds as a group outperform or give, it's a wonderful business for the hedge fund manager. I mean, 2 and 20 is a terrific compensation scheme. And I will tell you that some of the universities, including my own, that have done well with hedge funds usually don't pay those kinds of fees. They make their own arrangements. I will admit the following. There are a few hedge funds that, unlike a mutual fund where, you know, there's a distribution, but if the market has done 8, maybe the worst ones will do 3 or 4. With hedge funds, there's an enormous distribution. A lot of them, you know, go under and you lose everything. And so on the other side, there are certainly some hedge funds that have had extraordinary returns. And I would be the first to admit that. But I think in general, I think it's a great thing for the hedge fund manager. I don't think they're great things for investors.
Your survivorship bias reminds me of in college there was this rock band, and it got a few gigs, and it was so bad that it changed its name. And it got a few more gigs. So I thought that was a good strategy. Sandy? I'm sorry, over here, and then we'll get Sandy.
You had mentioned the value of rebalancing every year, and you mentioned, presumably there's a split between bonds and stock. But I wonder if you want to discuss, which is of equal importance, the ratio or when one should have higher stocks or deviate, in bonds, or what the ratio should be, depending upon being one's wealth or one's age.
I have always recommended that younger people have a portfolio that is far more heavily weighted in stocks. I think that they should be balanced, but a young person's portfolio, if it was 80 or 85% in stocks, I think that would be absolutely fine. I do think that over time, the other part of the rebalancing is one probably ought to have a somewhat lower allocation to stocks. Now, I don't think it ought to. I've actually changed my own view on this in that I've become very much more. I mean, Jack Bogle had an interview in the Wall Street Journal this week with Jason Zweig, and he said, I'm 85% bonds. Jack's 82 years old. I'm 85% bonds, 15% stocks. I don't think that that's actually right, even for Jack at his age, with multiple heart attacks and a new heart and so forth, because Jack's not investing for himself. Jack is investing either for charitable giving or for his children, so it's the age, in some sense, of who the money's designed for that's important. But look, in general, I agree with you. I think that probably the portfolio ought to be somewhat less aggressive with age, and that you can work into the rebalancing. That let's say that works for a decade, but at some point you want to get into a mix that's slightly less, that is slightly less aggressive. Having said that, what I wouldn't do is try to do it on the basis of my view as to whether bonds and stocks were good investments. That's the timing game that I think is going to get you in a lot of trouble.
Sandy and then David. Sandy Smith, no? Okay, I'm sorry. Maybe my eyes failed me.
All right, yeah. No, thank you. And for full disclosure, I'm one of those mutual fund managers. I have lots of questions for you, but I'd like to follow up on this on a personal finance angle. A lot of people use your theories to tell people to stay the course no matter what. And from my experience, most investors, as you point out, when the markets go well, are overinvested. And so if you take a period like 2008, where investors lose half of their net worth possibly in the stock market, the broker tells them, oh, you stay the course because the markets will recover. Now, my view has historically been, well, if you lose half your net worth, odds are that you can afford to lose less going forward, and therefore not staying the course may not be such a bad idea. Do you have any view or spin on that?
Well, you know, the answer that I will give you is that's exactly the time that and the Federal Reserve has then driven interest rates to zero, and your bonds are way up. That is precisely the time I want to take the bonds out and put them into equities. And I would say this, that in addition to one's age, clearly one's physiological makeup is very important. You don't want a portfolio that you can't stand. You know, as you know, the old classic J.P. Morgan story. The guy came to J.P. Morgan and said, I am just sick. I've got so much in stocks, it's going down so much, it's making me sick, I can't sleep at night. And J.P. Morgan said, well, I think you ought to sell down to the sleeping point. So So if, in fact, this is something where there's a certain amount that you need, you know, you're near retirement, there's a certain amount you need, you want to annuitize, you don't want to make sure that you've outlived your wealth and you can't afford to take risks, you shouldn't have been that high in equities in the first place. But I think if you've got the right balance for your age and for your risk tolerances, then I think you should rebalance.
David, then we'll go to the back.
So I have a question on your chart 3 where you talk about the worst days in the market, or the best days, but why don't you show the worst days? Because if you look at the 10 worst days and the 10 best days for the averages, they're about the same. So why wouldn't you show the net differences? I mean, it's just
fair enough.
Because this is
you
pretty
know,
biased.
it
That's all I
would
want
be
to
the
point
same
out.
thing. But let me just tell you that when those best days often happen, those best days typically happen at times like this that are times of great stress. You know, there's some relief rally that is huge. They often will come, those best days tend to come just when people are scared to death.
That's fine. I'm just pointing out that this is
Yeah,
not
no, I
evidence.
understand.
You should show the net difference between the 10 best or the 30 best or 30 worst. I'd be really curious about that. And also, why are you only picking 1996 to present versus a longer time period?
Oh, it could be the same kind of thing if you did it longer. It just we happen to do the data that way. It's something I did with Charlie Ellis in a book that he and I did, and we just happened to pick those days where we had the data. But I've seen them in previous periods as well. You get the same kind of thing.
The back.
So my question follows up on your comments regarding emerging markets. And the question is, do you feel that political risk is adequately baked into the emerging markets? And the idea that I would put forward is the following. If you suspend personal bias for a minute and just take a look at what's being reported in the Wall Street Journal or The Economist, and look at the BRIC nations, Brazil's cabinet is steadily falling apart. Russia is well known to be run by a bunch of former KGB thugs. And India and China are very well known to have highly corrupt political systems. So, as an investor looking into this picture, the conclusion you're sort of forced to draw is that when change occurs in one of these emerging markets, chaos tends to prevail. So I'm interested in your thoughts on whether political risk is adequately baked into those emerging markets.
There is most certainly political risk in emerging markets. I think that this is all a relative thing. I think, frankly, the risk in developed markets, I mean, I think it's well known, the risks that you're talking about, which is why people are very much afraid of the Chinas of the world. I would say that the political risks in Europe, for example, are enormous. How the Eurozone can hold together is a mystery to me, and I don't think it will. I think that if you want to talk about where there's likely to be chaos, I think it's much more likely, I'm much more worried about Europe than I am in China. And what I see in China is a few things that are at least getting better. They are serious about corruption. The head of the Chinese FDA was caught taking bribes and they killed him. I mean, they really are. You know, the rap on China is there's no protection for intellectual property. I think you are going to see that develop. Not because the Chinese want to protect our intellectual property, but because they're developing their own intellectual property. And you are, people are coming here to the United States to study intellectual property laws. It's not that I disagree with you that there are political risks, but I think the political risks are lessening there. And in terms of a return to communism, there's nothing like someone who lived through the Mao years to know that that doesn't work. These guys are bigger. I wish Nancy Pelosi talked to some of the same people that I talked to in China. So I don't disagree with you that there are political risks, but there are political risks everywhere, including, you talk about Brazilian cabinet, we've got a dysfunctional government now. So it's all relative.
That might be a pretty good point to end. Okay, we got a couple questions over here. He can hit another high note. I know he can.
Yeah. I just want to ask you about the Chinese demographic problem. They're going to be the fastest aging country in the history of the world, pretty much. Could you address that?
I sure would. I'm very glad you mentioned that. I think that that is an absolute misnomer. I think a lot of people say that's where the population bomb is really going to hit you. There's a statistic which I can't stand. It's called the dependency ratio. You know, you look at the working population and then you count the infants and you count the people over 65. You know, I can't stand it because it suggests if you're over 65, you're washed up and there's nothing useful that you can do. But let's say you look at these dependency ratios. If you want to be frightened about a country, look at Japan, where pretty soon there will be less than one worker for every dependent. China, at least for the next 15 years, looks much better than the United States, much better than Europe. The birth rate in China, with its one-child policy, is higher than the birth rate in Catholic Italy and Catholic Spain. The fact of the matter is, at least for the next 15 years, the dependency ratio statistics show that China is going to be just fine, and there are probably 500 million unemployed or underemployed people in the center and the west. China will have plenty of population to grow. Will they get into a problem later with the one-child policy? I think they will. The problem they're already having is there's a big mismatch between boys and girls, and they're very practical, though. They're starting in some provinces to give a bounty if you'll raise a girl. Sometimes they're bribing people. In some provinces you can have a second child if you raise a girl. They're very practical. When that starts to hit, my guess is they change the policy.
Well, I don't think it will surprise you if I tell you a true story, which is namely the Princeton undergraduates voted him as the best professor at Princeton.
Thank you.